So now, let's go to project budgeting and cost control. So let's first define what is project budgeting. So project budgeting involves calculating the total cost of all activities required to complete a project. Or a project budget is a financial plan that outlines how much money is needed and how it will be spent. So first, of course, in project budgeting, you have to define the project scope. This clearly defines the project's objectives, deliverables, and expected outcomes. So this step is essential for accurate cost estimation and resource allocation. Second is estimate the cost. So you have to break down the project into smaller tasks and estimate the cost of each. Consider the labor, materials, equipment, and other relevant expenses. Number three is you have to allocate resources. So you assign resources to specific tasks and ensure they are available when needed. This includes personnel, equipment, and materials. Number four is monitoring and control. You have to track the actual cost against the budget throughout the project lifecycle. Make adjustments as needed to stay within the financial limits. In budgeting and cost control, there is what we call S-curve. So the S-curve is a visual representation of the cumulative project budget over time. So basically, this is just a graph of the budget over time. It helps you track progress and identify potential cost overruns. So in the S-curve, there are three stages: the early stage, the mid-stage, and the late stage. So to give you the picture of what is S-curve, so basically this is your S-curve. You have your time and your cumulative project budget. So this is the early stage, this is the middle stage, and this is the late stage. So the early stage of the curve gradually rises. It reflects the lower cost in the initial planning and setup phases. And the mid stage, the curve accelerates as more resources are deployed and activities reach peak intensity. The late stage, the curve flattens, as you can see on the curve that I have shown you earlier. So the curve flattens as the project near completion. Cost stabilizes as activities wind down and resources are released. So why is project budgeting important? So these are the advantages of project budgeting. A well-defined project budget offers numerous advantages, including improved decision-making, enhanced control, and clearer communication. So first, you have to establish guidelines. So if you created your budget on a certain project, you establish guidelines. A budget acts as a roadmap identifying clear financial boundaries and objectives. It provides a framework for making informed decisions about resource allocation and cost management. Second is cost estimating. So budgets enable accurate cost estimates, allowing financial managers to understand the financial implications of various decisions. This information helps in making informed choices about resource allocation and task prioritization. The third one is prioritizing. So a budget helps prioritize tasks based on their cost and impact on the project's overall success. It ensures that critical activities receive sufficient funds and resources. The fourth one is cost control. So budgets provide a baseline for monitoring and controlling project costs by tracking actual expenses against the budget. So the financial managers can identify potential overruns and take corrective actions. So creating a project budget requires careful consideration of several critical factors. By addressing these factors, businesses can create a realistic and achievable budget that supports project success. Number one is the activity cost estimates. You assess the potential cost associated with each project activity, taking into account the labor, materials, equipment, and other relevant expenses. Next is the basis of estimates. You develop a thorough method for documenting cost estimates, including assumptions, risks, and uncertainties. This ensures transparency and accountability. And third is scope baseline. So what is scope baseline? This defines a clear project scope, including deliverables, milestones, and acceptance criteria. This provides a framework for accurate cost estimation and resource allocation. Number four is project schedule. You have to create a detailed project schedule that outlines the sequence of the task, their duration, and resource requirements. This helps estimate cost more accurately. Number five is resource calendars. You can develop resource calendars that include working days, holidays, and other factors affecting resource availability and costs. So if you're a financial manager, you have to know how to keep the project within budget. So to keep the project within budget, first, you have to make a realistic budget. You start with a realistic budget that accounts for all potential costs and contingencies. Avoid overly optimistic estimates that can lead to financial difficulties later on. Second is to avoid scope creep. So scope creep actually occurs when project requirements change unexpectedly, leading to increased cost. This occurs especially if there is a change in the management. So we have to avoid scope creep, establish clear project boundaries, and manage change requests effectively. Number three is resource time. You have to track resource time accurately to ensure that project activities are completed within the allocated time frames. This helps prevent cost overruns caused by inefficient resource utilization. And fourth is bill rates. You have to understand the bill rates for different resources, such as labor and equipment. This information is crucial for accurate cost estimation and budget management. So a lot of project encounters delays and even stops is because of common budgeting mistakes. So many pitfalls can lead to budget overruns and project failures. So these are the common budgeting mistakes. First is underestimating cost. You're not accounting for all potential expenses. For example, the car repairs or the machine repairs. Or the team estimates that the machine only costs 5,000. However, it ends up to be 7,000. So this discrepancy can lead to resource shortage. Second is scope creep. So we already defined what is scope creep. So it is allowing project requirements to change without proper planning or cost analysis. For example, there's a change on management or the stakeholder is requesting an additional feature, additional material, or the stakeholder changes the original material that is to be used, which is more costly than the original one. So that unexpected changes will also lead to unexpected cost, which greatly affects the resources. Number three is inefficient resource allocation, misusing or underutilizing resources leading to wasted time and money. For example, is you're assigning a senior engineer to complete a minor task that could be handled by a junior staff. So because of that, there will be a labor or increase of labor cost. The fourth one is lack of communication. So poor communication within the project can result in misunderstanding and budget overruns. So the financial team should be informed always if there are changes, or else they will be using outdated cost projection and thus this will result to cost overruns. That's why it is very important to control cost. So cost control is a process of identifying and minimizing business expenses to increase profit. So all business and project wants to increase profit and of course control the cost. That is why cost control is important because you can track your budget. So cost control methods often involve setting a strict budget for a team to follow, which is helpful in staying on track during the project. Second is cost growth prevention. So by using cost control method, You keep the project costs from rapidly growing as the project progresses. Number three is profitability enhancement. Of course, if we will lower the cost, there will be an enhancement of or increase of profit. So cost control methods allow for the revenue brought in from the project to be higher than the cost of the project, which keeps the profitability high and increases a company's finances. So these are the factors of cost control. First is cost of labor, the sum of wages paid to employees working on the project, including employee benefits and taxes, is the cost of labor. Second is the cost of the materials. It's the total cost of all supplies and equipment required for a project is a cost of material. Third is actual cost. So actual cost is the total expenses that the project has cost from the beginning of the project to the end of the project. The fourth one is cost variance. So cost variance refers to any differences in price between the actual cost of the project and the budget that you have set. So for example, the budget that you have set is 5,000, but then the actual cost is only 3,000 or 7,000. So there is the cost variance. So these are the cost control methods: budget planning, expense monitoring, change control system, time management, and earned value tracking. Now let's go to financial decision making in engineering projects. Financial decision making in engineering projects involves critical steps to ensure that the project is viable, profitable, and efficient. So here are the general framework of the steps. First is you have to clearly define the scope, objective, and specification of the project. We have to answer the questions such as what is the purpose of the project? What are the technical requirements? And what is the expected outcome? Second is we have to conduct feasibility study. First is a technical feasibility. Assess the availability of technology, resources, and expertise to implement the project. Second is economic feasibility. We have to evaluate the financial viability of the project, including the profitability, cost effectiveness, and return on investment. Third one is the legal feasibility. It examines the compliance with laws, regulations, and permits relevant to the project. Number four is environmental feasibility. You have to assess the potential environmental impact of the project and compliance with the environmental regulations. The third one is cost estimation. We have to estimate the total cost of the project, including the initial investment, operational costs, and life cycle costs. In this step, we have to break down the project into components, such as materials, labor, and equipment. Next is we also have to include contingency costs for unexpected expenses and also consider inflation, taxes, and financial costs. The fourth one is cash flow projections. We have to project future cash inflows and outflows over the project's lifetime. That includes initial investments, operating expenses, revenue generation, and loan repayment. The next one is financing options and capital budgeting. We have to determine how the project will be funded and assess different investment options. We have to look into the internal financing, that is, to use the company funds. We also have to look into external funding, such as loans, bonds, venture capital, and equity. And also, we have to look into the capital budgeting methods. We have to evaluate the project profitability using NPV. NPV stands for net present value. You calculate the present value of the future cash flows. Next is IRR. IRR stands for internal rate of return. You assess the profitability relative to cost. Next is payback period. You are to measure the time required to recoup the initial investment. And also PI. PI stands for profitability index. You are to determine the value created per dollar invested. And then, risk analysis and mitigation follows. In this portion, you are to identify and quantify risks associated with the project and prepare mitigation strategies. The key areas that you have to look into are the market risks, financial risks, technical risks, and regulatory risks. And after looking into those critical steps, decision making comes in. You are to base on financial analysis, and risk assessment to decide whether to proceed, to delay, or to abandon the project. To proceed, it means to continue with the project based on the positive financial analysis, risk assessment, and alignment with organizational goals. Delay means you are to postpone the project due delay. It means Delay, it means you are to postpone the project due to unfavorable Delay, it means you are to postpone the project due to unfavorable market conditions, funding constraints, or risk factors that require further mitigation. The third one is abandon. This means that you are to terminate the project based on significant financial risk, lack of feasibility, or misaligned with organizational priorities. If you decide to proceed on the project based on the positive financial analysis, risk assessment, and alignment with organizational goals, here comes implementation and monitoring. After the project is initiated according to the approved plan and budget, you have to do financial tracking. You have to establish a system to monitor costs, revenues, and cash flow throughout the project. Then you have to do regular reviews, that is to compare actual performance against planned targets and adjust strategies as needed. And the fourth one is adaptive management. You are to respond to market changes, unforeseen challenges, and evolving project needs. And lastly, post-project evaluation. After project completion, evaluate the financial outcomes and overall success of the project. In this stage, you are to analyze profitability and return on investment. And you also have to assess overall project achievements and impact, and also review variances and identify contributing factors. And of course, we have to capture insights for future project improvement. These following steps ensure a structured, data-driven approach to financial decision-making in engineering projects, balancing technical feasibility with financial viability and risk management. And finally, here is the final cost estimate of a commercial rental spaces. This Excel file contains the financial information of the project and how they relate to financial decision-making in engineering management. So the first sheet contains the total project cost. As you can see, it is labeled as TPC. So TPC means total project cost. So the first sheet contains the total project cost. As you can see, it is labeled as TPC. So TPC means total project cost. Here we can see the total cost of the project, which is crucial in understanding the capital investment required for the development. So we can see here the total construction cost, which is 17 million. And we have here the licenses and building permits and the occupancy permits. So the total project cost is approximately 19 million. So as you can see here below is the sources of financing. So we have here the bank and the owner. So this is the bank is the external funding and the owner is the internal funding. The next sheet is labeled as IS. So IS stands for income statement. So these are the income statement of the commercial rental spaces for first floor, second floor, and you can see here also the potential gross income, effective gross income, and the operating expenses of the project, and also the net income of the project. And also in this sheet, we can see the income tax computation. In this sheet, the income statement, it projects the revenues and expenses over a period of time. So in this case, it is 10 years. So this is critical for understanding the profitability of the project over time. And the third sheet is labeled as CFS, or the cash flow statement. So the cash flow statement, it tracks the inflows and outflow of cash. So we can see here cash inflows and cash outflows. It shows how the project's liquidity is managed, and this helps in planning for short-term financial obligations and ensuring that the project does not run into cash shortages during its life cycle. The fourth sheet is labeled as BS, or the balance sheet. So in this sheet, it provides the snapshot of the project's financial position, including assets, liabilities, and equity. The balance sheet is what the financial engineering managers need to assess the financial health of the project, particularly in the terms of asset management and debt repayment capabilities. And the fifth sheet is computations. So in this sheet, we can see additional calculations related to project assumptions such as rental fees. And also here, we can also see the licenses and permits and vacancy and credit loss allowance. Then the second to the last sheet is FR, or the financial ratios. Financial ratio help financial manager to make informed decisions about the project's return on investment, or ROI, and long-term sustainability. So by doing financial ratios, you can estimate the payback period. So in this case, it states here that the payback period is 10 years. And the last sheet contains the amortization. We can see here the repayment schedule for loans and financial assistance. So how much will you repay for the first month? As you can see here, first year, first 12 months. So the total amount is 4.8 million that is already including interest. And the second year, the third year, so on and so forth until you totally repay the loaned amount. And I think that's all for financial management in engineering. I hope you gained something. Thank you for watching.